Welcome to our Affordable Care Act Compliance Seminar. This seminar is entitled Understanding the Measurement Methods under Employer Shared Responsibility, and I am Susan Grassli. I am an attorney here with GBS Benefits. So I always like to go over our agenda for our seminars, and today we'll do a really quick overview of the ACA, how these four parts of the ACA fit together: the individual mandate, the exchanges, employer shared responsibility, and market reforms. And then we will jump right into employer shared responsibility. We'll do a really quick review of steps 1, 2, and 3, and then jump into step 4 and specifically into the measurement methods. So here are the basic parts of the Affordable Care Act. There's the individual shared responsibility, also referred to as the individual mandate. That's the mandate that requires individuals to get a coverage for themselves and their dependents or pay a penalty. Then we have the employer shared responsibility, also referred to as employer mandate, and that's the provision that requires employers to offer coverage, health coverage, to their full-time employees or be exposed to possible penalty. And we have the third part of the Affordable Care Act, which is the exchanges. The IRS renamed the exchanges marketplaces, but I think they're still referred to as in both ways. And the subsidies that can sometimes be obtained within the exchange or marketplace if an individual purchases within there, and if their income and their other qualifications meets the requirements. And then finally, our market reforms. Now, these first three, the individual mandate, the employer mandate, and exchanges, are what I like to refer to as the big three. They kind of dovetail together to create the heart of healthcare reform, but we also can't forget about market reforms. There are several provisions under this sort of bucket that employers need to be aware of, and if they don't comply with that, there are penalties attached as well, and there's a whole list of them. So today we're not talking about those, but here's a plug for understanding that you need to be aware of those as well, and we will have a seminar on that in the future. We've done them in the past, and we'll bring that up again soon. So that's the basic part, the four parts of the ACA. Today we're focusing on employer shared responsibility, or just that part. So we will, within employer shared responsibility, do an introduction, an overview, and a review of the steps, and then go on to the measurement methods. So the steps to compliance, we created 4 steps. I used to do a seminar, several years ago when we first started doing this, and I didn't have it in steps. It was just a lot of information to take in all at once, and decided that the best way to help you all wrap your heads around it was to break it down into steps, and those steps have to be done in a particular order. So if you are anxious to get to step 4, that's great, but please be patient and make sure you do steps 1, 2, and 3 before you do, because that information is really important to understand and know before you get to your step 4. So step 1 is determine employer size. Step 2 is determine compliance date. Step 3 is determine what will be offered. And step 4 is determine which employees will be offered coverage and when. And again, that's what we're going to be spending most of our time on, is step 4, but we do need to really quickly review steps 1, 2, and 3. So step 1, determine employer size. An employer must know its official size as determined under employer shared responsibility rules. There's a specific way of calculating your size, so make sure you understand that. When we give you the step 1 packet, it will have all the information in there, and actually a calculator for you to actually properly calculate, but you will need to input certain bits of information, and you'll need to understand certain things. So read all the information that's in that packet. I'm not going to go over it today. This is the only slide we're dealing with on it today, and it's just a reminder that when you are dealing with your size under employer shared responsibility, there's sort of 3 areas that sometimes trip up employers so that they get the wrong size. First of all, there's control groups and affiliated services groups. You need to, if you are part of a controlled group or affiliated services group, you need to include all of the employees from all the entities in order to determine your size. So just a reminder for that, we have information about controlled groups and affiliated services groups in this step, and if you aren't aware of whether you are part of one of these groups but you think you may be, you will want to get a tax professional to help you determine that. Next, we have contingent employees. These are a situation where you're dealing with temporary employees, either as a leasing agency or an employer who's hiring or using or the services of a temp agency and the workers within there. There's a big deal and big need for understanding on, if you are dealing with these sorts of employees, on who is the employer in this situation, the leasing agency or the employer that's hiring these workers. So make sure that you are aware of that when you deal with step 1. And full-time employee equivalents and seasonal employees. This is part of the actual calculation, and you'll want to be aware of what full-time employee equivalents are, how you calculate it, and the seasonal employee rules within this step. So that's our reminder for step 1. And again, if this is new to you, you will want to actually listen to or attend our seminar that is specifically on all 4 steps, and it goes into detail on each step and not just on step 4. So step 2 is determine your compliance date. That is really important to determine when you are exposed to penalties. There used to be one compliance date. It was January 1st, 2014, but now there are several possible effective dates / compliance dates depending on a lot of factors. A summary of this really quick is, if you got 100 or more in our step 1, your compliance date may have been, or your exposure to penalty date may have been January 1, 2015, or it may have been a month within that year. If you got between 50 and 99 in step 1, your compliance date or your effective date when you're exposed to penalties may be sometime in 2015, but it also may be sometime in 2016. There is a transitional rule that lets some employers within this size not be exposed until this year, 2016, but that's not automatic, so you'll want to try and figure that specific. You will want to, not try to, but figure out your specific exposure date or compliance date. And then, of course, if you got under 50 in step 1, you're a small employer and you don't need to go on to the steps, and you don't need to continue listening to this seminar. Step 3 is determine what will be offered. There are 2 possible penalties if you as an employer don't offer an ACA compliant plan. What needs to be offered to avoid exposure to the first penalty? Well, the first penalty is technically called the 4980HA penalty. Sometimes we call it the non-offering penalty, and in that case, in order to avoid it, you need to offer minimum essential coverage to substantially all your full-time employees and their dependents. Most plans meet minimum essential coverage unless you've put together a skinny plan. And substantially all full-time employees means, at least starting with 2016, means 95% of your full-time employees. In 2015, it was 70%. And what needs to be offered to avoid exposure to the second penalty? That second penalty is referred to as the 4980HB penalty, but sometimes we call it the minimum value penalty or the affordability penalty. But in any case, even if you offer full-time coverage under the first penalty option, if you offer coverage to all your full-time employees, but what you offer is not affordable or doesn't meet minimum value, then you would be exposed to that type of penalty. So, to avoid both penalties, we deal with this in step 3. We confirm and want to determine your where you are on all 3 of these things. Number 1, whether you're offering coverage to at least 95% of your full-time employees. And that step 4 also helps you with that. But we also check your minimum value, and as well as your minimum essential coverage, but your minimum value in step 3, and we also check your affordability in step 3. And within affordability, you're going to be, or you have, either way, chosen a safe harbor to help you to calculate the actual affordability. And just as a side note there, if you'll notice, monthly premium for single coverage must not exceed 9.66%. For those of you who've been listening for a while, you understand that it used to be 9.5%, then it was 9.56% for 2015, but in 2016 it must not exceed 9.66%. So that's the quickest of reviews of step 1, 2, and 3. Again, if this is a little confusing to you and you haven't been exposed to this kind of information before, you are listening to a seminar that is a little intermediate for you. You need to go back and listen to a couple of other seminars, one that gives you the big picture on the Affordable Care Act and just kind of how it works all together, and how the big three sort of dovetail to create the Affordable Care Act, or the heart of healthcare reform. And then you need to listen to a seminar that is the 4-step seminar that goes through steps 1, 2, and 3 in detail. But for those of you who don't need to do that and need to focus on step 4, we are moving on to determining which employees will be offered coverage and when. So, employees who work full-time and their dependents should be offered coverage. That's a big part of step 4, but we need to determine which employees need to be offered. Full-time is defined as an employee who works 30 hours per week, or an employee who works 130 average hours per month. Both are acceptable ways of determining full-time employee. I will tell you that because of the way the measurement methods are set up, that it is easier to deal with the monthly average, the 130 average hours per month. Dependents, how is that defined? Who is it that you actually need to offer to? Who's a dependent? That is your employee's children up through age 26, and it does not include the spouse. Now, of course, you can offer coverage to the spouse, and many of you do. You're just not penalized for not offering to the spouse if you don't. The way it works here on step 4 in identifying full-time employees is based simply on tracking and counting hours. Now, here's the thing that sometimes gets employers tripped up when they first are exposed to this rule. It doesn't really matter what you classify or call your employees for other purposes outside of the Affordable Care Act. It simply matters for these purposes how many hours they work. For example, outside the ACA, an employee may be classified as part-time, temporary, or seasonal, or whatever you call them. But under the ACA, if an employee works the required amount of hours, she or he will be full-time and will need to be offered coverage in order to avoid a penalty. So don't let the fact that you call somebody part-time trip you up, because that part-time, quote-unquote, employee may actually be full-time under these rules. Now, when you are tracking hours, when this basic kind of tracking and counting hour system, you are counting hours not only that your employees work, but also employees where they don't work, but they're paid for that work. And together these hours are referred to as, quote, hours of service, unquote. So sometimes I may refer to tracking hours, but specifically and technically what you need to be doing is tracking hours of service. So let's talk about that a little bit more. All hours of service should be counted when tracking. That means you count all hours that are worked, hours actually worked, and which includes overtime hours, but also credited hours. That means hours for which an employee is paid or entitled to payment even when no work is performed. For example, you may have paid vacation, paid holiday, illness, incapacity/disability, layoff, jury duty, and military duty, and so on. You are counting all of those hours or hours of service when you are tracking this. So what happens if you have an employee that you do not pay by the hour, or you do not track hourly at least? It doesn't matter whether you pay them by the hour, but it matters whether you track their hours. So, the simplest solution to that is to switch to tracking their hours. You don't have to pay them hourly, but you could still track their hours for these purposes. If you can't do that for whatever reasons, and I know that there's some circumstances where it just doesn't work, you are offered what's called the equivalency hours method by the IRS, and they say this is a day's worked method or a week's worked method. And basically, the day's worked method is, we don't have a lot, let me back up, we don't have a lot of explanation about how this works, but there's a paragraph or so on it in the regulations. And the days worked method, well, there's more than that, but just the point is there's not a whole lot on it. But the days worked method is basically where you give credit for 8 hours for that day, for each day that is worked, even if it's a partial work day. Same thing with the weeks worked. You give credit for a full week or a full 40 hours a week for each week that's worked partially or in full. So if you need more information on that, let us know and we can forward the actual language to you so you can see how that works. Counting hours can be done in many ways, and some ways may not create an accurate result. Meaning, employers may come up with a million different ways of tracking and it's not accurate. So the IRS did come up with a resolution to this issue by creating a safe harbor to help the process of identifying full-time employees. And that safe harbor includes the monthly measurement methods and the look-back measurement methods. And that's the focus of what we are discussing today. So let's just jump right into this new section then, employer shared responsibility measurement methods. So the safe harbor, like I indicated, includes 2 measurement methods to track hours and identify full-time employees. It's the monthly measurement method and the look-back measurement method. Now, really, really simple summary of monthly measurement method is where you count each employee's hours of service during each month. If during that month they averaged 130 hours or more, then they would be considered eligible, and employees could go in and out of eligibility for coverage on a monthly basis. Technically, that could be in and out. A very brief summary of the look-back measurement method is where you are going to track each employee's hours of service during a specified period of time. Usually that is a 12-month period of time. That's the most common. And if during that 12 months the average is 130 hours or more, that employee is identified as full-time and someone who should be offered coverage, and they are therefore eligible for coverage for a full stability period that follows right after that, which would be another 12 months. So we'll talk about that in a lot more detail, but let me give you the general rule when using the measurement methods and determining whether you're going to use the monthly measurement method or the look-back measurement method or so on. Here's the technical explanation, and then on the next page I'm going to give you an approach so you don't have to worry about all the technical stuff. That is probably we feel is the simplest way for you to administer it, to be the least amount of headache for you. But here's the technical one because you need to be aware of it. You must use the same measurement method for all employees in the same category, even for full-time employees with consistent hours. So, in other words, what does that mean in the same category? Generally, you've got to use the same measurement method for all employees, but there are 4 categories that I have listed here where you can use different measurement methods if it falls within these 4 categories. So you've got salaried versus hourly employees. You could use different methods, different measurement method for salaried employees and a different measurement method for hourly employees. Also, employees in different states. If you have employees in Utah, you could have a different measurement method with them than you have with those who are in California and those who are in Idaho, for example, or in any other actual state. So then we have 2 that deal with unions, collectively bargained versus non-collectively bargained, and then the final category is separate groups of collectively bargained employees. So unless you are using one of these 4 categories, of employees, you have to use the same measurement method for all employees. So here's the simplest way of dealing with it. Forget about all that, in my opinion, and just decide to use the same measurement method for all categories of employees, including those categories that are listed there. You're just going to say, we are going to use the look-back measurement method for all categories of employees. That is what we feel is the simplest way to approach this process. If you decide to do this, that means that you will, for all of these employees, have their hours tracked using the look back. Full-time employees, even though you know they're full-time, they will be tracked under under the look back measurement method. Part-time employees, variable hour employees, seasonal employees, employees paid with salary or by the hour, and who are in different locations, and who and so on, or different unions and so on, or union versus non-union. I should add those there too, but those aren't as common. So in other words, no matter who your employee is, you are saying that you are going to track their hours of service using the look-back measurement method. That is the basic simple approach. Now, there is an exception that you need to be aware of that is required. It's not something that's an option. Even if you are using the look-back measurement method for all employees, which is that big list of things we have right here on the slide, any newly hired employee who is reasonably expected at the time of hire to be full-time must have their hours tracked using the monthly measurement method. And this is only temporary. If you've selected the look-back measurement method for all categories of employees, this monthly measurement method that is used for full-time, newly hired, reasonably expected to be full-time employees is just temporary. Okay, let's talk about this a little bit more so you understand it a little bit better. So, again, the rule is you must use the monthly measurement method for all newly hired employees who at the time of hire are reasonably expected to work full-time. What happens then? For these employees, the employee should be offered coverage within your 90-day waiting period. Now, as you know, or you hopefully know, the 90-day waiting period rules or provisions under the ACA are separate from the rules, the employer shared responsibility rules, but they dovetail in that they both have to do with waiting for coverage, and they both need to be complied with. So in order to comply with both the employer shared responsibility rules and the 90-day waiting period, you are going to need to offer to these employees coverage no later than the first day of the month following 2 months, or no later than the 90th day after hire. So we have some employers who have a shorter waiting period within this rule, and you can do that. Obviously, you can be more generous. So you could offer coverage the first day of the month following 1 month, or the first day of the month after hire, or the first day you begin working. It can be any of that. It just can't be more than that. And again, if you're using the look back for measurement method for all categories, this monthly measurement method is temporary. Eventually, these employees who are newly hired will be transitioned into having their hours of service tracked and within the look back measurement method. Okay, so how long do we use the monthly measurement method? You say, Susan, you say it's only temporary. How temporary is that? When do I stop using it? When do I start using the look back? We'll go into more detail when we get into the actual technical rules of the look back, but here's the sort of teaser. The monthly measurement method must be used until the newly hired full-time employee becomes an ongoing employee. Once an employee is an ongoing employee, there is no requirement anymore to use that temporary monthly measurement method. You're going to drop that off and only use that standard look back measurement method. Now, an employee becomes an ongoing employee at the end of the first standard look-back measurement method after hire. Now, for some of you who are new to this standard look-back or any of these measurement methods, that might not make any sense to you, and we will cover it again. But for those of you who know a little bit more, understand that an employee becomes an ongoing employee at the end of your first standard look-back measurement standard look-back measurement period after you hire this new individual. Okay, so if an employer uses the simple approach, meaning the simple approach is that all employees have hours of service tracked and counted using the look-back measurement method, and of course, except for those who are newly hired employees who are reasonably expected to be full-time because they have to go temporarily into the monthly measurement method. So assuming you've got this is your setup, this is your foundational measurement method policy, the result is that you as an employer will need to only deal with 3 basic categories of employees at any given time. You've got your newly hired employees, reasonably expected at the time of hire to be full-time. You've got your newly hired employees, not reasonably expected at the time of hire to be full-time. And you've got your ongoing employees. So here is a graphic that hopefully helps that understanding this. This graphic applies or is an example where again you're using the simple approach and where you select to use you decide to use the look back measurement method period for all categories of employees. If you decide to use a variety of them, you're going to have a lot more going on than this. So this is the simplest approach. So you can see we have 3 sort of buckets. We've got 3 columns, and these are the 3 categories of employees that you need to kind of keep separately in your mind and be aware of. The first bucket is newly hired employees who are at the time of hire reasonably expected to be full-time. So we've already talked about this one. We know will go temporarily into the monthly measurement method and then eventually transitioned into the standard look-back measurement method. Your next category of employees are newly hired employees as well, but they are not expected to be full-time. So it's everybody else who is not reasonably expected to be full-time, plus it is also full-time employees who meet the seasonal employee definition, and I'll talk about that in a minute. So that kind of is an exception to that rule. But for those employees, what you're going to do is they immediately go in the look back, but they go into an initial look back first, which is temporary, just like the monthly measurement method. And then eventually they are transitioned into the standard look back. So again, newly hired employees who are not expected to be full-time are initially or at first put into the look back, which is called the initial look back measurement method, and then eventually they are transitioned into the standard look back. So there are 2 different kinds of look back, and we'll talk about that in a minute. And then your final category of the 3 buckets sort of that you need to keep separate in your mind are your ongoing employees, and they're the simplest, of course, because they go right into the standard look back. You don't have to put them in some sort of temporary anything. So the key is to make sure you are correctly placing an employee in one of the 3 categories. So to determine whether a newly hired employee is reasonably expected at the time of hire to be full-time, the regulations give a little bit more explanation. So this seems to be the most difficult place to correctly categorize your employee, because you would think that it's super easy to say, okay, well, I've got somebody I'm hiring and they're going to be full-time, or I've got somebody that I'm hiring and they're going to be part-time. But there are, as you are well aware, some of you, that it's a little bit more complicated than that. So the first thing, and the IRS is aware of this, so the first thing the IRS has said, or one of the things the IRS has said in trying to answer this question is, first of all, you can consider several factors. Here are the 4 factors that we are suggesting that you could consider, but there are other considerations as well that we haven't listed and that would be perfectly fine. But here are the 4 that we're listing. This is the IRS talking. So, is a new employee replacing a full-time or part-time employee? That may give you a clue or some help as to determining whether you are reasonably expect them to be full-time or part-time. Do employees in comparable positions work full-time or variable hour or part-time? Was the position advertised as full-time or variable hour or part-time? What do provisions say in the job description or employment contract? Does it say if they're full-time? So if all of these questions point to full-time, then you can reasonably expect this newly hired employee to be full-time. If not, then maybe they'd be variable or part-time or seasonal or so on. So that seems to answer most questions, but then there are some additional complications that come up, and that deals with temporary, short-term, and project employees. I get a lot of questions about, well, I hired this person to be full-time, but I know they're only going to be with us for 9 months. And the answer to that is that type of employee would be put into this category, into this bucket, the bucket of we are reasonably expecting this newly hired employee to be full-time. We don't expect them to be with us for, for more than 9 months, but the IRS, that's not part of the question. The question is just whether you expect them to work full-time or not. So, an example, an employee who is hired to work full-time for just 6 months in a non-seasonal position should be considered full-time upon hire and put into that particular category. Now, we have another area that we need to talk about, and we kind of alluded to it on the last slide, but it is what about seasonal employees? And I indicated that they have an exception if they fall within it. But here, as we've have it written here, it's a newly hired employee reasonably expected to work full-time at the time of hire does not need to have coverage offered up front if the situation meets the Step 4 definition of seasonal employee. In other words, they would not be put in that category of reasonably expected to be full-time, even though they are going to be full-time. They would be put in that middle category, which is not reasonably expected to be full-time at the time of hire, just because it's a seasonal employee exception, and that's just how they set it up. So, what if an employee is expected to be full-time but is hired for a seasonal position? This is a little bit more detail on the seasonal employee exception. So we're going to help you understand what the definition is and how it works. A newly hired employee reasonably expected to work full-time hours but who meets the Step 4 definition of seasonal employee does not need hours tracked under the monthly measurement method. Instead, a full-time seasonal employee, or part-time for that matter, would go right into that middle category that I had on the graphic, the category that says not reasonably expected to be full-time and those who meet the seasonal employee definition. And their measurement method would first be the initial look back, and then eventually they would be transitioned into the standard, just like we have on that chart. If you need to flip back to that chart a few pages back, that graphic, to help you, that kind of, I think, is helpful in keeping those 3 buckets of categories, the 3 different categories straight in your head. So what is the actual definition of a seasonal employee under Step 4? It's different than the seasonal employee definition under Step 1, just so you're aware. Don't confuse that definition. Step 1 definition, again, I repeat, is different from the Step 4 definition. So let's talk about the Step 4 definition. A seasonal employee is a worker who is in a position for which the customary annual employment is 6 months or less. Now, customary is a really important word to understand the definition of, so let's define that. According to the IRS, customary, quote unquote, means employee typically works each calendar year in approximately the same part of the year, such as summer or winter. So it's not just somebody who works 6 months, but it's somebody who customarily works 6 months or less at the same time of year, such as summer or winter. Examples: a newly hired employee is expected to work full-time hours for summer parks and recreation, and that season ends in 5 months. That would be a seasonal employee, somebody who was only brought on seasonally, meaning for the summer season for a city, and assuming the summer season is 6 months or less. Another example, a new employee hired to work full-time hours for a winter ski resort, and the season typically ends in 6 months. That would be another example of a seasonal employee. Now, let's change it up a little bit. What if a particular winter ski resort's season typically ends in 8 months? If their season typically ends in 8 months, then they would not fit the definition of a seasonal employee. Even though you call them a seasonal employee, they would not be a seasonal employee under these rules, under the ACA, Employer Shared Responsibility. Our final example is a new employee who's hired for what you call seasonal work, but it ends in 7, 8, 9 or so on months. That is not a seasonal employee. You can call them seasonal if you want, but under the employer shared responsibility rules, they are not, and you would need to put them in that first bucket of categories. Remember, we've got the 3 categories. That would be an employee who's reasonably expected to be full-time at the time of hire, and not the second bucket. Okay. So we have spent our time with some foundational information, and we have just talked about the measurement methods in general, meaning what they are, what the general rules are. We've got monthly and we've got look back. Now the rest of the time we are going to spend on just the look back measurement method. You understand now, hopefully, when to use the monthly and when to use the look back. And now we're going to say, okay, now that you know you're using the look back, let's get into the details of how to technically administer the look back correctly. Okay, generally, as an overview, a measurement period under the look back is a period of time between 3 and 12 months. Most employers are picking 12 months. You can choose, where you track employee hours of service to determine whether employee is full-time and eligible for coverage. Remember, you're going to do some averaging, do some math at the end of that measurement period. Administrative period is a period of time where you're going to calculate the hours of service. You're actually doing the math. You're going to identify who is working 130 hours or more in a month, and you're going to approach those individuals and offer coverage and make sure that they understand that their coverage would be effective day 1 of the stability period. The stability period is a period of time between 6 and 12 months. Usually it's 12. If your measurement period is 12 months, it's got to be 12, and we'll talk about that a little bit more, but where a coverage is effective. So this is a period of time where they're eligible, and they remain eligible through this entire period of time. We're going to say it's 12 months in this example, even if their hours go down. So they earned it. If they earned it in the measurement period, they are eligible for the full following associated stability period. Now, it's important to understand, and you've probably picked this up already because of that graphic of the 3 categories of employees that you have to worry about, but there are 2 different kinds of look-back measurement methods. They are similar in a lot of ways, but they also have some differences, so you need to understand them. We have the standard look-back method and the initial look-back method. The standard look-back method is a method for all ongoing employees and eventually for all other employees, assuming like I said, you've selected the simple approach that we suggest, which is you're using the look-back method for all categories of employees. So the initial look-back method is a temporary method for newly hired employees until they become an ongoing employee. And remember, it's newly hired employees that are not reasonably expected at the time of hire to be full-time. Those who are reasonably expected at the time of hire to be full-time would be put in the monthly measurement method, not the initial. And again, if you want to refer back to that graphic that has the 3 categories, that should help. But here it is again, the same graphic. So we've got the 3 buckets of employees again. These are the only 3 categories you need to worry about if you go with the simple approach that we suggest. And again, that simple approach again is selecting the look-back measurement method for all categories of employees. The 3 categories include newly hired employees who are reasonably expected to be full-time. We have talked about how they first go into the monthly measurement method and they're transitioned into the standard look-back. Now we're talking about the look-back method, and we're talking about how there's an initial look-back method and a standard look-back method. So this applies only to this category in the middle, this category of employees. And these are the newly hired employees who are not expected to be full-time at the time of hire, and also full-time employees who meet the seasonal definition, and of course part-time employees, anybody else that is not newly hired and reasonably expected to be full-time. They are again at first or temporarily put into the initial look back and then transitioned into the standard look back. So we are first going to talk about the standard look back, and then after we talk about the standard look back, we're going to talk about the initial look back. So we have here this sort of graphic to help you see how it really is pretty basic. If you think about it, you just have to select. If you look up at 11 o'clock there, you've got select. That's where you start. Track, do the math, offer, and repeat. So let's first talk about select. An employer selects a look-back period called, and it ends up being called the standard measurement period. The length of this measurement period can be anywhere between 3 and 12 months. Like I've indicated before, most employers are using the 12-month standard measurement period. Generally, the standard measurement period must be the same amount of time and start the same time for all current employees, but there are exceptions, and those exceptions are listed here. These 4 categories. I am telling you about this because I want you to be aware of the rules, but for simplicity's sake, I would not have different measurement methods for the different categories of employees. I would just simply choose the same measurement period and same time for all of your ongoing employees or any other employee that is put into this standard. So we won't spend much time on that because it's much simpler not to use these categories. If you want to talk further about using these categories, I am happy to talk to you about it offline, so contact me, but we're just going to skip over that and say the simplest thing to do and the approach we recommend is to have the same measurement period for all of your employees. Now, I do get questions about this. Can the employer change can we change our measurement period? Yes, you can. You need to wait till the full cycle ends before you change it, though. You can't change it up in the middle of a cycle. So, in addition to selecting your measurement period, you also need to select your stability period. And there are specific rules about it, and you don't have a lot of leeway. It's not technically selecting, because if you selected a 12-month measurement period, you have no choice. You have to have a 12-month stability period. But I'll tell you the rules anyway. So it has to be, the stability period has to be at least 6 months, 6 consecutive months, and it can't be shorter than the measurement period. It has to be at least as long. So again, the easiest way to approach this is if you have a 12-month measurement period, your stability period is going to be 12 months. If you have a 6-month measurement period, you could have a 6-month stability period or longer, but most people just match up the numbers and they would make it be 6. So 6 measurement period and 6-month stability period. So that was our select. Now we're moving on to track. Tracking there's not a whole lot to say about this other than you're just required to keep accurate records. There's no specific technology required for tracking. You can come up with your own Excel spreadsheet. You can hire a vendor to do your tracking for you or something in between. You just need to make sure you're tracking hours of service accurately. The benefit of tracking hours I have listed here is just that the safe harbor actually gives you greater flexibility when you're scheduling and working, specifically variable hour employees, because you can allow those employees over a 12-month period to sometimes work full-time and sometimes work part-time, as long as their average over that full 12 months doesn't exceed 130 hours per month, then you're fine. So as long as you're trying not to offer coverage too. So that's sort of the benefit of this sort of longer 12-month tracking. And here's an example of how it could technically track. Now this is just an example. I have this here because I've been asked about, well, I don't get it. How do you actually do it? So here we have listed in the first column, we've got employee's last name, first name, hire date, and what your standard measurement period is and when it starts. In this case, the standard measurement period starts each December, because it's a 12 months, so you would just, for each December, you'd go in and document and input the hours that each employee worked. So employee A is 73 hours, employee B didn't have any hours, employee C didn't have any hours, and so on. So that is just simple. We do have this basic Excel tracking sheet for you. If you want, you can come up with your own or come up with any other way you want to technically track it. But you can see at the end of this, it adds your total hours. Like for employee A, the total hours for the 12 months was 942.75, and you're going to divide that by 12. And the average then, the monthly average for employee A is 78 hours and 78.56 hours. So this employee is not full-time. So hopefully that example helps you. So we've selected and tracked, and now we're doing the math. That's simply, you are adding up like we just did on that prior page. You're taking the total hours for all 12 months and dividing that by 12 if your measurement period is 12 months. So for example, you have an employee who worked 1,252 hours total in the entire 12-month time period. You would take that and divide it by 12, and whatever your number is, if that number is under 130 hours, which I believe it would be, then that individual is not considered a full-time employee and would not be eligible for coverage. But if it's over 130 hours, they would be. So the math would be the same idea. If you have a 6-month period, you're going to take the total hours worked in all those 6 months and divide by 6. And if your number is 130 or more, they're eligible and full-time. And if not, they're not. So hopefully that makes sense. Then we're going to offer. So in other words, if the employee averaged 130 hours or more per month, they need to be offered coverage. If the employee averaged less than 130 hours per month, they do not need to be offered coverage. Certainly you can be more generous in this and offer coverage to those. You can set up a policy that is, if they work 120 hours or 110 hours or 100 hours or 90 hours per month, whatever it is, you can be more generous, but you just have to at least offer to those who are working 130 hours or more per week. So how long is an employee eligible when you offer this? They must be eligible, and we talked a little bit about this before, but they must be eligible for health coverage during the full associated standard stability period, regardless of the hours the employee works during the standard stability period. In other words, it doesn't matter if the employee starts working fewer hours during the standard stability period, the employee still earned eligibility for the full stability period and should be able to remain on if they would like to do so. Now, for the following measurement period, if they're working fewer hours than the next stability period, they probably wouldn't be eligible. But for the period that they did earn it or were 130 hours or more average per month, they would need to be locked into that stability period. And then you simply repeat the process all over again. In other words, the standard measurement period and standard stability period are continuously repeated. As soon as standard measurement period 1 ends, standard measurement period 2 begins. In other words, you can't have a 10-month measurement period and then wait for 2 months and start your next measurement period 2 months later. As soon as your standard measurement period ends, the following month you're starting up again. So for administrative ease, we also have an administrative period that the IRS suggested, and that is takes place during the do the math offer phase, which is the administrative period. And this is basically just a period of time to allow you to do your work. In other words, to do the math and to offer coverage to those who are eligible, to answer their questions, collect the materials for the employees and enroll those employees who elect coverage so that they are ready and on coverage by day 1 of the stability period. Now there's rules about the administrative period, and basically that administrative period is kind of an analogous to a waiting period. Once they're eligible, they can't wait longer than 90 days. Typically employers, because we're working within the measurement period and the look back period specifically, it's easier to wrap your head around and to administer if you turn it into months. So you would either choose a 1-month administrative period or a 2-month administrative period. For example, first of the month following 1 month or first of the month following 2 months would be when your stability period starts. So here's a graphic of what this looks like. You've got your measurement period, your administrative period, and your stability period all cycle 1, and then you start, and then of course when measurement period 1 ended, you started measurement period 2, and then you have an administrative period 2, and then you have stability period 2. So it just continuously cycles, at least the measurement period and the stability period continuously cycle. The administrative period only hits in that 1 or 2 months. Okay, here's an example. Example with an administrative period added where the employer selected a 12-month measurement period, a 12-month stability period, a 2-month administrative period, and the plan year starts January 1. And your effective date, which you discovered during step 2, is January 1 as well, 2015. So this is the most common scenario that we have because most of you who got more than 100 in step 1 have calendar year plans, although I know there are exceptions. And so this is what your cycle likely looks like when you put together your step 4 measurement method policy. November 1, 2013 to October 31st, 2014 is your standard measurement period 1. This is because you need to do all your measuring before January. Remember, your effective date is January 1, 2015. You've got to do your measuring prior to that time in order to determine who needs to be on coverage by January 1. Because that January 1 is your standard stability period, or when your first standard stability period starts. Okay, so November 1st, 2014 through December 31st, 2014 is your standard administrative period. Remember, they picked a 2-month administrative period. And then January 1 is not only your effective date that you discovered during step 2, but it's also day 1 of your standard stability period. And that is because we lined it up to make sure that is when your first stability period starts. We want you to have it be administratively easier to deal with this if we line it up with when your plan starts, and if we line up your administrative period during your open enrollment. So again, that's the logic behind this. So this particular one, employer would have open enrollment sometime between November and December 2014, so that coverage is actually starting and effective with January 1. When is the standard look-back measurement method used? Okay, so we've talked about the standard look-back method and how it works. Those are the basics. But let's refresh our minds on when we use the standard look-back measurement method. We use it we use it in several ways. Here's the 2 bullets. First, you use for ongoing employees. An employee who was hired prior to employer's first or original standard measurement period is an ongoing employee. So in other words, back on that other slide, the first measurement period 1, started November 1st, 2013. So that anybody who was an employee prior to that date would automatically be an ongoing employee. Anybody hired after that date would be considered a newly hired employee until they have been with you through 1 full standard measurement period. So this second dash, any employee who has worked with the employer through 1 full standard measurement period is technically an ongoing employee, and therefore you would use the standard for them. Now, not only do we use the standard look-back measurement method for ongoing employees, but remember, we use it for newly hired employees beginning or starting with the first full standard look-back after date of hire. So remember, this is used along with the temporary measurement methods of either the monthly measurement method or the initial look-back method. So remember, we have those 2 buckets of employees: newly hired employees not reasonably expected to be full-time who go in the monthly, and newly hired employees, sorry, let me restate that. Newly hired employees reasonably expected to be full-time at the time of hire go into the monthly temporarily, but then they also at the same time have hours tracked under the standard, starting with the first standard look back that starts after their date of hire. Same thing with the other category, that middle category of employees on that graphic. So in other words, employees who are not reasonably expected to be full-time at the time of hire, that middle category, their employees' hours are first tracked in the initial look back, but they are also tracked under the standard look back, starting with the first full standard look back that begins after the date of hire. So here again is the graphic so you can see. Again, newly hired employee reasonably expected to be full-time, the purple box. They immediately start measuring or tracking the hours of service with a monthly measurement method. But as soon as the first standard look-back measurement method starts with this employer, if it's a 12-month measurement method, say it's the example we talked about a couple slides back, it would be every November 1st, a new standard look-back measurement method starts. So as soon as we get to November 1st, you're going to start tracking them on that method as well. So temporarily, you're tracking a newly hired employee reasonably expected to be full-time under both the monthly measurement method and the standard. And then eventually the monthly measurement method will be dropped off and you'll just keep them in the standard. Same idea with this middle category, the teal box, newly hired employees not reasonably expected to be full-time plus seasonal. They, as we've talked about, immediately go into the initial look-back measurement method, but as soon as you hit that first standard look-back measurement method start date for that employer that we just talked about, that would be November 1st, and you would also start tracking their hours of service there as well. So for this category, they'll have their initial look-back measured and all their hours of service tracked not only under the initial but also under the standard. Okay. So when does a newly hired employee become an ongoing employee? This kind of dovetails with what we're talking about here because a newly hired employee becomes an ongoing employee at the end of the first standard look-back measurement period after hire. So you start tracking their hours along with the other temporary way at the beginning of the first standard look-back period after hire, and then at the end of the first standard look-back period after hire, when they've gone through that whole look back, usually 12 months, then they are officially considered an ongoing employee and you can drop off that other temporary method. So at this time there's no more what I like to call dual measurement methods. You're not tracking them on two different methods. Here's an example of dual measurement methods or using two methods, and we've talked about it already and I'm going to say it again just because I know this is particularly confusing. Tracking hours for a newly hired employee not reasonably expected at time of hire to be full-time is going to be tracked under both the initial look back and then the standard, but eventually you're going to drop off the initial and just have the standard. And then you do this as soon as you get to the end of the first standard look back period after hire. Same thing with monthly. Tracking hours for a newly hired employee reasonably expected at time of hire to be full-time. At time to be full-time are tracked both under the monthly measurement method temporarily and then the standard. So as soon as you get to the end of the first standard, you're going to drop off the monthly measurement method. And from this time forward, under both examples, you're only going to use the standard look back. So here's an example to hopefully help it make a little bit more sense. Employer elects to apply the look-back measurement method to all employees. Okay, so that's what we're suggesting. Do the simple approach. Just select the look-back measurement method for all employees. Employer hires an employee who's reasonably expected to work full-time. So, as we've learned, that employee would have hours of service initially tracked using the monthly measurement method and would have coverage offered within the 90-day waiting period. And that's typically going to be the first of the month following 1 month, or the first of the month after hire, or the first of the month after 2 months. So, in addition, on day 1 of the first standard measurement period after hire, employer also tracks the new employee's hours using the standard look back. So now we're using both tracking methods. The employer continues to track hours using both the monthly measurement method and the look-back measurement method until the end of the first standard measurement method. First standard measurement period. So that first measurement period. At the end of the first standard measurement period after hire, the new employee is now considered an ongoing employee, and the employer can now drop off the monthly measurement method and only measure this employee's hours in the standard look back. Here is a graphic of this idea, so we're going to talk about it really quickly just to hopefully make it really cement in this idea. So this particular employee was hired on March 1st of 2014. Now, remember, this chart works assuming that you've gone the simple route and selected the same measurement method for all categories of employees, and that you've selected the same measurement periods for all categories of employees. So this new hire hired March 1st, 2014. So from March of 2014, April, May, June, July, August, and September, you are only tracking using the monthly measurement method. As soon as you hit October 1, this particular employer's standard measurement period starts on October 1. Every year, they have a 12-month, and every year it starts October 1st. So as soon as October 1st hits, in addition to the monthly measurement method, we are also going to track this newly hired employee's hours using the standard measurement period. So for October, November, December, January, February, March, April, May, June, July, August, and September, we're doing both methods. Now, at the end of that September, you're going to drop off the monthly, but before that time, what if an employee who's in the monthly measurement method's hours drop? And your policy that you've written down says that if it drops consistently over 3 months, then they get off coverage. What do we do? Are you using the standard or are you using the monthly? You are going to use the monthly measurement method until you get to determine whether they're off and on, because you're just measuring the standard at this point. So continue to use the monthly measurement method from March 2014 through September of 2015. But in the same time, you're also tracking hours in the standard starting with October 1st, 2014. Hopefully it makes more sense and I haven't totally confused you. But hopefully all these examples and explanations help move you forward. And of course, if you have any questions, you can also contact us as well. So we are now moving on to the initial look-back measurement method. We've talked about the standard look-back measurement method, and now the initial is for newly hired employees who are not reasonably expected to be full-time. That's who's going to be put in this look-back measurement method. Again, the initial look-back measurement method is for those, remember those 3 categories of employees? It's for that middle category, the middle category of those who are not reasonably expected to be full-time at the time of hire, plus those who meet the seasonal employee definition. And again, we have track overlap, which is a little bit different. Do the math, offer, and select. So you can see here I've got these side by side. We've got the standard look-back measurement method and the initial look-back measurement method. They have some similarities, but they do have some differences. So some of this will be repeat and review because it's just exactly like the standard, and some of the rules will be different. So pay attention. First of all, we're going to select. We're going to select your measurement period, and we're going to select your stability period. So this first bullet, let's talk about selecting your standard measurement period. That should say initial. That first bullet says employer selects a look-back period called an initial measurement period. Sorry about that. But the length can be anywhere between 3 and 12 months. Like I said, most are choosing 12 months. It may be different in length from your standard, but like I've been telling you all along, let's make your life simpler and choose the same length as the standard. You also, so let's say, for example, you go with a recommendation, you go with 12 months. The employer also needs to select a stability period, and that, again, the rules apply. They're exactly the same as the standard. If your measurement period is 12 months, your stability period has to be 12 months as well. If your measurement period is 6 months, you can have a stability period that's 6 months or longer, up to 12 months. Okay, so we've selected. And now we're talking about tracking. And again, tracking on this first bullet is just the same we talked about in the standard, in that there are no specific, you're just tracking the hours. There's no specific technical rules about it. But it is a little bit different from standard in that when you start this, you are going to, the date to start your measuring under the initial look back or tracking is the date they start working. In other words, each new hire has his or her own unique initial measurement period start date. So you don't wait until the standard rolls up. You start your initial immediately. And this is different from the standard measurement period because all current employees are measured on the same dates over the same period every year, and these newly hired employees will eventually be in the standard, but for now they're temporarily in the initial, and you need to start tracking their hours immediately. So track overlap, that just explains that in addition to tracking the new employee's hours during the initial measurement period, the employer also starts tracking the new employee's hours during the first standard. And we've talked about this probably ad nauseum for some of you. But again, the idea is you start immediately tracking under the initial measurement period, and as soon as you hit your first standard measurement period after hire, you're also going to start tracking their hours under the standard as well. For example, employee A is hired and starts working April 1, so the initial measurement period starts April 1. Remember, the initial. The standard measurement period for all ongoing employees starts each year on November 1st, so the employer also starts measuring or tracking employee A hours of service on November 1 in the standard. So we have both methods going for a while. April 1 is initial measurement period. Starting November 1, it's initial measurement period and standard measurement period. And this is an example or a graphic to show you. The initial measurement period just happens once and then you stop. But your standard will continue. So your initial measurement period will drop off and you'll continue to, once that temporary measurement period is finished, you'll just continue each year in the standard. Okay, we also need to talk about the administrative period, which is a little bit different than the standard. It's the same in that the part of your administrative period is going to be during the do the math and offer stage. That's the normal period of time, but you also have the option of having part of your administrative period at the beginning before you start tracking. Now, when I initially learned about this several years ago, 4 years ago, whenever it was, oh gosh, it's been longer than that, 5.5 years ago, I thought, why would anybody want to make things complicated? But actually, once you wrap your head around this, it actually makes your life simpler if you do this. So let's talk about it. Why would you want a split administrative period? You do have an option. You can have the same administrative period as standard, meaning you can just place the initial measurement period before you can place the administrative period after the initial measurement period and before the initial stability period. Or you can split it, which means that part 1 of your administrative period is before the initial measurement period even starts. And then your initial measurement period starts, and then you have part 2 of the administrative period, which is placed after initial measurement period and before the stability period. I'll show you a graphic of this on the next page, but let's finish this explanation. Hopefully it'll make more sense when we go through an example. So all initial measurement periods for new hires start the first day of each month if you do it this way. Otherwise, if you don't split it, you will have, you could technically have a different 365 different initial look back periods going. And that, of course, is not a realistic example, but technically it could happen if you hire a new employee who needs to be put in the initial every day of the year. You could have 365 different ones. So in order to make your life a little bit simpler, you could reduce the possibility of having a variety of different look back cycles down to 12, one for each month. And this is how it works. Here's our example. Employer hires 2 employees within the same month. Employer wants to start tracking hours of all employees hired within the same month, starting on the first day of the following month. So they're saying, I don't want to have an initial measurement period starting on the 2nd, and on the 10th, and on the 12th, and on the 18th, and on the 21st, all the days that I hired somebody new. I want to take all the people who I hire in a particular month and start them in an initial measurement period at the same time. The first day of the following month. So this is how it works. So employee A starts on March 12th and employee B starts on March 23rd. Initial administrative period part 1 for employee A goes from March 12th through March 31st. The initial measurement period part 1 for employee B goes from March 23rd to March 31st. It doesn't matter that their initial administrative periods are slightly a different amount of time. It's just any time within that month it's just considered or called a partial month. Then the initial measurement period for employees A and B both starts at the same time. That starts on the first of the month following the month they were hired, which is April 1, and it goes through the following March 31st. And then the second part of the administrative period, part 2, starts, and that's 1 month. It can only be 1 month because of a special set of rules, and that would be April 1 to April 30th, 2015. And then their stability period starts at the same time as well. That would be May 1st. So that is an example of why you would want split. If I were doing my own measurement method, a policy, this is what I would select. I would select a split initial administrative period. And again, this only applies to the initial look back. It does not apply to the standard. It can't be split in the standard. And for this particular initial look back cycle, that part 2 administrative period may only be 1 month. It cannot be 2 months. In the standard, you can have a 2-month measurement period kind of sandwiched in between the measurement period and the stability period, but for this you can only have 1 month, and that's because of a special set of rules we'll have on this next slide after this. But here is a graphic of how this works. The split, it's just that part 1 of the administrative period is before the initial measurement period starts, and part 2 of the administrative period is sandwiched in between like normal. Or you can have your normal one, which is just 1 administrative period that's not split and it's in between. But that assumes that you are then starting your measurement on the day, your initial measurement period on the day each individual employee is hired. So the special rule that I was talking about is that you cannot have that part 2 of your administrative period be more than 1 month. And again, you can have it be 2 months for the standard, but it can only be 1 month. So you can only have 1 and a partial months for your administrative period and initial, and that's just because that's how the IRS decided it was going to be. They decided you cannot make somebody wait more than 13 and a partial months before they are determined to be eligible or not eligible for coverage. So again, part 1 of your administrative period, if it's split, would be a partial month, and part 2 of your administrative period can only be 1 month. So we've done select, track overlap, and now we're going to do math, which is the exact same as the standard, so we won't spend a ton of time on this. It's just if the measurement period is 12 months, you're going to add up all the hours for every day of that 12 months and divide by 12 to get your average. If that average is over 130, then they're or 130 or more, they're eligible for coverage. Same thing with 6 months. If it's 6 months, you add up all the hours for 6 months and divide it by 6, and so on. So remember to do the same at the end of the standard measurement period. When you're using both cycles for this category of employees, you're using the initial measurement period and the standard measurement period. They are overlapped, but you treat them separately. So make sure you do a stability period for the initial, and you do a stability period for the standard, as well as the administrative period. So then offer, which is what we've already talked about. If the hours are 130 or more, then they need to be offered coverage, and if not, they do not need to be offered coverage. You can look to the next administrative period to do your next math to determine eligibility. Remember, there is only 1 cycle for the initial look back method. There is no repeat. If the employee is still working, he or she will be already looped into the standard look back. So, and the next time hours are averaged would be at the end of the standard measurement period. Now, remember that we've talked about this, but the initial stability period and standard stability period will in fact overlap, but remember to apply them separately, which is just what we were talking about just a minute ago. So, we have talked about the basic rules of the standard look-back measurement method and the basic rules of the initial look-back measurement method. Remember, the standard is used for ongoing employees as well as for newly hired employees once they're looped in, and the initial look back is just for one category of the three categories you have to worry about, which is employees who are newly hired employees who are not expected at the time of hire to be full-time. Okay, so now we have some additional rules that apply to both the standard and the initial. So let's talk about how So the issue here is what to do with employees who return from unpaid leave. Now remember, if they are returning from paid leave, there's not an issue because they get hours of service, right? That's hours of service you give them credit for. But if they're returning from unpaid leave, the question is, are they coming back as a newly hired employee? Therefore, I have to deal with the newly hired employee questions. Or are they coming back as an ongoing employee? So you need to figure out how to categorize them or classify them in order to know how to continue or to start tracking their hours of service. So IRS came up with a solution. The regulators did, and they've created two special rules when determining whether the employee is an ongoing employee or a new employee when they come back. We've got the 13 weeks rule or the rule of parity. Now, this applies to everybody except for those who are in educational institutions. If you are an educational institution or organization, you are going to replace 13 with 26. So it's the 26 weeks rule, or under the rule of parity, you would replace the 13 with 26 as well. We'll talk about that here. So the first option is the 13 weeks rule. So this rule, okay, let me back up. I have some of you ask me, well, which rule is better to choose? When you are putting together your step 4 measurement method policy that's written, we have a template. And in that template, you have lots of different choices because you have choices within this whole measurement method, within these measurement method rules. When you will get to a part where it asks you to select either the 13 weeks rule or the rule of parity, and I said, well, I don't know what to pick. Well, I can't pick for you, but I can tell you that the 13 weeks rule is a little bit more advantageous for employees, and the rule of parity is a little bit more advantageous to employers. However, the rule of parity is a little bit more complicated to wrap your head around and to administer, and the 13 weeks rule is a little easier. So the easy rule has the potential, not necessarily, but has the potential to be a little easier on your or in favor of your employees. But if you are the employer who doesn't care if they are eligible for coverage or would affirmatively like them to be eligible, then the 13 weeks rule is probably the direction to go. So here's how the rule works. Where there are no hours of credit, in other words, they were on for the period of time they were on unpaid leave, and the period is greater than 13 consecutive weeks, when they come back, they are considered a newly hired employee, and you start all over again with your tracking. You'd give no credit for hours that were worked prior to them leaving. However, if the period of time that they were gone on unpaid leave is less than 13 consecutive weeks, then you are going to consider them an ongoing employee, and therefore they would be put in the standard measurement period, and you will give them credit for the hours that they worked prior to leaving. So, examples: employee takes unpaid leave for 15 weeks, then returns. So, because they were gone for 15 consecutive weeks, they were gone longer than 13, so when they return, they would be considered a newly hired employee. Second example, employees rehired after 12 weeks of being gone. When they return, because they were gone for less than 13 consecutive weeks, they would be considered an ongoing employee, and therefore they would be put back in wherever they were in your standard, wherever you are in your standard, and they would be given credit for hours they worked within that period, within that cycle. The second option is the rule of parity, sometimes called the the at least 4 but less than 13 weeks rule. And again, this would be for educational institutions or organizations, this would be called the at least 4 but less than 26 weeks rule. There are 3 different categories you've got to keep track of. The first is where the period of time they were gone is less than 4 consecutive weeks, or the period of no hours of service. When they were gone for less than 13 consecutive weeks, they are automatically treated as an ongoing employee when they return. When the period of time they were gone is greater than 13 consecutive weeks, when they return, they're automatically considered a newly hired employee. So if you can see a pattern here, under both rules, the 13 weeks rule and the rule of parity, if they're gone for more than 13 consecutive weeks, they are considered newly hired and you don't have to deal with it. But the rule here on the rule of parity is the period of time between 4 and 13 consecutive weeks. You've got to do a little bit of math and figuring. So if the period of time that the employee was gone is greater than 4 consecutive weeks, but less than 13 consecutive weeks, you've got to do some math. And what happens is whichever number is higher wins. For example, if the period of time that they were gone is greater than the period of time that they were there with you in that cycle, then they would be considered a newly hired employee when they return. If the period of time that they were gone is greater, if the period of time they worked is greater than the period of time they were gone, then when they return, they would be considered an ongoing employee. So let's talk about some examples, so maybe that will make more sense. I have examples here at the bottom. There's examples of an ongoing employee, then a newly hired employee, then an ongoing employee, then a newly hired employee. So let's talk about the first one. Employee works 8 weeks. There are no service hours for 5 weeks, meaning they were gone for 5 weeks. So the period of time they worked, 8, is greater than the period of time they were gone. So therefore, when they come back, they're going to be considered an ongoing employee. Next example. This is an example of a newly hired employee because the employee worked 5 weeks, but the period of time they were gone was 8 weeks, and 8 is greater than 5, so this employee would be considered newly hired. Example of an ongoing employee. Employee was gone for 3 weeks, 3 consecutive weeks. Well, that amount of time is less than 4 weeks, so they're automatically considered ongoing. Less than 4 weeks, right? Because remember the rule up here, if they're at the first bullet up at the top, where no service hour period is less than 4 consecutive weeks, they're considered an ongoing employee. And the same thing with the bottom one, the newly hired employees. They're gone for 14 consecutive weeks, and because of that, you look at the second bullet up above, where no hours of service period is greater than 13 consecutive weeks, in this case 14 weeks, they're considered a newly hired employee. Okay, so let's say you have selected a rule, either the rule of parity or the 13 weeks rule, and you have an employee who left on unpaid leave, and you took them through your test, and the test says they are to be considered an ongoing employee. How do you apply it? What do you do once they return as an ongoing employee? Well, for employees who are identified as an ongoing employee upon return, the measurement and stability period that would have applied had the employee not taken a break continued to apply upon the employee's return to work. For example, if an employee returns to work during a stability period in which the employee should be treated as a full-time employee, and after you do the calculations, of course, that employee must be treated as a full-time employee through the end of that current stability period and must be immediately put on coverage. Immediately means as soon as the employee works 1 hour of service or as soon as administratively feasible. In other words, there is no waiting period. There's no waiting period because this employee is not considered a newly hired employee, right? There's no waiting periods for ongoing employees, only for newly hired employees. Okay, so hopefully that makes sense. Now, there's even an exception to that rule. Say, for example, that you have an employee, you've selected your rule of parity or 13 weeks rule, and you have an employee leave, and they left for FMLA, and it's unpaid leave, but it's FMLA leave, or it's military or jury duty, whatever the case is. All 3 of these categories get special treatment. If you have somebody leave on or return after unpaid leave under one of these 3 categories, these rules, the 13 weeks rule and the rule of parity, or whatever rule that it is you chose, do not apply, because these, like I said again, get special treatment. These employees are automatically going to be treated as an ongoing employee, not newly hired employee. That means that the employee will be considered an ongoing employee, and that the measurement and stability period that would have applied had the employee not left continue to apply even upon the employee's return to work, just like on the prior slide. But in addition, not only are you giving them credit for the hours they worked before they left, but you're also going to give them credit for hours of service as if they had never left. In other words, for the period of time that they were gone, they get credit for, they get service hours of service credit. So in order to, well, how do I know what hours of service credit, hours of service, right, credit do I give to this employee? Because they didn't work those 2 months. Well, you average the hours that they were working before they left, and then you just simply input that average into those months or period of time that they were gone. Okay, the other rule that we want to talk about really quickly, and we're almost out of time, just so you know we're almost finished, is when employees have a change in job status. So I don't even like talking about this in some ways, because I think it gets some people confused. So it's really, really important that you understand the distinction here. If there is a change of hours, you just follow the normal look back measurement method rules. There's no exception, there's no special rule. However, if you have a situation in which you have an actual change, an employee has an actual change in job status, meaning that they go from one type of job to another type of job, or they change officially from full-time to part-time, or part-time to full-time. And I don't mean it's somebody who's in a variable hour schedule and their hours are going up and down. No, that's just normal look-back stuff. But this is, if there's an actual official change. For example, you have an employee you hired as part-time and they become your rock star employee. They're just amazing, and you want to promote them into a new position that's full-time. That is an example of a change in job status. So how do we deal with that? Because we get a lot of questions with that, assuming there's an actual official status. Well, there are a set of special rules, and those special rules are on these 2 pages right here. And it depends. It depends on a lot of factors. So you say, okay, I have this person, they have this change in status, it's official, I know I'm supposed to look at this exception. How do I know it's exception to apply? The first thing you do is say, were they in their initial look? Are they in their initial look back, or are they in their standard look back? If they're in their initial look back, you're going to apply one of these 2 rules. If they're changing from variable hour, seasonal, and part-time to full-time, then you've got that rule there at the top. If they're changing from full-time to variable hour, seasonal, and part-time, there should not be a problem, because there shouldn't be anybody in this situation, because only newly hired employees who at the time of hire are not expected to work full-time are put in the initial. So you shouldn't have somebody in that situation. But anyway, make sure you follow these rules. If you have a change from variable hour, seasonal, part-time to full-time, and they're in their initial look back, the employer must offer coverage by the earlier of either the first day of the associated stability period, assuming that they're averaged 130 hours or more, or the first day of the 4th month after the change in status. So you have 3 months in order to get them on coverage. And here's the rule: if you have somebody who has a change in job title, position, or status, and they're currently in the standard look back, you have a different set of rules. If the change is from variable hour, seasonal, part-time to full-time, you're basically just following the look-back rules. But if you have a change from full-time down to variable, seasonal, and part-time, there is a limited situation in which you can take them off coverage early before the end of the cycle. But this rule listed here must be followed. You can take the employee off coverage as of the first day of the 4th month. This is before and this assumes it's before the end of your look back cycle or stability period. but you have to meet 2 requirements. And these requirements are somewhat hard to meet based on my conversations with some of you. It does not necessarily happen very often, but you can only take them off coverage if that employee had continuously been offered coverage starting from their eligibility period at their very first initial hire date, and they're averaging for the next following 3 months 130 hours or less than 130 hours per month individually for the first 3 months after the change of status. In other words, their change of status is happened at the end of October. So November they had to be under 130 hours, December they have to be under 130 hours, and January they have to be under 30 hours. And if that's the case, then February 1 you could have them off coverage. Okay, we just have next steps, which is just another few minutes, and we're almost out of our 130 minutes, or an hour and 30 minutes, sorry. Here's just a quick review. Again, step 1 is determine employer size. Step 2 is determine compliance date. Step 3 is determine what will be offered. And step 4 is determine which employees will be offered coverage and when. This seminar did a brief review of steps 1, 2, and 3, but focused on step 4. Now, the next step is, if you have not completed all 4 steps, you need to do that immediately. That not only helps you with compliance and employer shared responsibility, but you may have discovered it is really hard to do your information reporting, your 1094C and your 1095C forms if you haven't done this, because these steps give you that information you need as well. But complete all the 4 steps. If you haven't, if you have, spend time on step 4, learning the measurement method. It takes time to learn this process. If this is the first exposure to these rules, you're probably going to need to listen to this more than once, maybe several times. This is very common. Don't feel bad that it's frustrating, because you are not the only one. So then you want to create your written measurement method policy. We have a template for this, which is part of your step 4 process. And it kind of helps you walk through it. You're going to need to make some decisions, but we give you some foundation and some background to hopefully make it a little bit easier and some suggestions to hopefully make it easier for you. Then once you have it in place, determine your tracking technology and begin tracking. Remember, there's no special rules about how you technically track, whether you have your own Excel spreadsheet, whether you hire a vendor or some other option. Just make sure that if you are using a vendor for tracking, either for employer shared responsibility or for information reporting, please do not let the vendor talk you into changing your measurement method policy unless you're fully informed as to why that policy would be advantageous for you to change. Some of the vendors have a process that if you do it their way, it makes their technology work a little bit better and is easier for them, but it is not necessarily easier for you to administer. The suggestions that we make here in this step 4 measurement method seminar are specifically designed for making your life easier and simpler, and so you can wrap your head around this and do it correctly. So again, there's a reason we have you go through all the steps. If you feel comfortable with this process, and you have a vendor who tries to change your mind, please stay firm on sticking with your measurement method policy that you put together. Make sure to determine eligibility according to your written measurement method policy. In other words, once you have completed your step 4 measurement method policy and you have a question, the first thing you want to do is turn to that measurement method policy and say, okay, I have this employee, this is my question, the answers are here in my measurement method policy. It will help me know how to address this. If the answers aren't there, and sometimes that happens, or if you're confused, we certainly can help you. But know that that's your go-to place. That's where your answers are, is within your measurement method policy. And even if you don't have questions, make sure you're actually applying it. I've talked to some who they go through the whole process, do their measurement method policy, finish all step 4, and then they're still applying their policy that was old, that was prior to this. So you have to actually implement this process. And then make sure you update your summary plan description and any kind of employee communication so that your employees are notified of how they can become eligible. And again, our last slide is just a reminder that the employer shared responsibility steps not only help you get in compliance with the employer shared responsibility provisions so that you can hopefully prevent any kind of penalty under that provision, but also helps you with information reporting. And you will need to continue the steps, not all of them, but step 1. In some cases, if you are bordering on the threshold of being above or below 50, and in all cases, step 3. In step 3, you're going to need to repeat step 3 because it's your confirming each year whether what you're offering meets minimum essential coverage, minimum value, and affordability. And each year, you're going to make sure that what you're offering and what you're charging, especially and particularly, meets affordability. So, that is the end of our seminar. I'm so glad you're listening in. Please listen again. Hopefully that will help you. If you have questions that aren't covered here or you're confused about something and you can't figure it out otherwise, please let us know. We are here to help. If you are working on your measurement method policy, once you have that done, remember to make sure to understand what that is, to actually implement it, and really get to know what those rules are so you know how to apply it if a situation comes up. We are also going to be offering starting in May, and part 2 of this Understanding Measurement Methods under Employer Shared Responsibility. We will review next month the 4 steps, and in particular the general rules of the measurement methods, but that will be not very much of our time. The bulk of our time will be actually running through examples of an actual employee situation using a variety of different measurement method policies. So hopefully the bulk of our time will be spent running through examples so you can kind of get a better idea of how to apply it. And we'd want you to bring actually your measurement method policy with you so that you can apply the situation to your actual measurement method policy, even if it isn't talked about in the seminar. So thank you, and we will hopefully be talking to you soon about how we can better help you with this. Thanks so much.